So this is our investment project, Project 2, and it is by Grant Henderson, Noah Stortz, Logan Keller, Mitch Wood, Hayden Francois, and Gage Knudsen. All right, so for part 1, task 1, we analyzed the return properties of two Dow Jones Industrial Average stocks. We chose Coca-Cola and Microsoft, along with the S&P 500 index and the 3-month Treasury bill, which we ultimately use as our risk-free asset in this case. First off, we calculated key statistics such as average return, standard deviation, covariance, and correlation. What those each mean: first off, the average return shows the historical performance of the asset, while standard deviation just measures the volatility of the asset in the market. Covariance indicates whether the asset tends to move together, and correlation scales the relationship between the two assets on a scale of -1 to 1. As seen in our table, Microsoft had the higher average of 0.0208 or 2.08% compared to Coca-Cola, whose average return was 0.0058 or just 0.58%. However, Microsoft also had a higher standard deviation, which means more volatility in the market. The correlation between Coca-Cola and Microsoft was approximately 0.30, suggesting a weak positive relationship between those two. All right, then for test 2 of part 1, we were supposed to construct some portfolios. The portfolios we constructed would be the global minimum variance portfolio and the optimal risky portfolio, or the Sharpe ratio. First off, for the global minimum variance portfolio, this portfolio minimized risk by allocating 69.44% of our money to Coke, while the other 30.56% of our money will go to Microsoft. With this, we get an expected return of 1.04% and with a standard deviation of 4.17%. On the other hand, for the optimal risky portfolio, which maximizes the Sharpe ratio, I put into Solver a couple of times. The ratio seemed correct. I got the highest Sharpe score with that combination every time. It tells us that we should put 100% of our money into Microsoft while putting 0% into Coke. With this, we get an expected return of 2.09%, while the standard deviation is 6.12%. This offers the best risk-adjusted return according to the Sharpe ratio. This suggests ultimately, from the Sharpe ratio perspective, that Microsoft alone is the best choice among these two stocks. Finally, the last task of part 1 was to put the portfolios into a visualization and interpretation. This graph presents the mean variance frontier, which illustrates all possible portfolio opportunities for using our two stocks in this scenario. First off, the green dot represents the global minimum variance portfolio, which has the lowest possible risk among our combinations, while the red dot represents the optimal risky portfolio, which lies on the efficient frontier and provides the best return per unit of risk that we will be taking on. The black line is the capital allocation line, which connects the risk-free rate asset to the optimal risky portfolio. This line represents all possible combinations of the risk-free rate asset and the optimal risky portfolio. This ultimately maximizes our Sharpe ratio for the investors. This graph visually confirms that Microsoft, despite its higher volatility in the market, offers the best risk-return trade-off between these two stocks in this setup.
We were supposed to pick 3 additional stocks from the Dow Jones and add them in alongside Coca-Cola and Microsoft. So we picked Salesforce, Johnson & Johnson, and NVIDIA. And I got their past 10 years of monthly returns and calculated the average return of the past 10 years. So Salesforce averaged about 1.6 per month, Johnson & Johnson 0.5% per month, and NVIDIA 5.5% per month. As well, below that, I have the variance of those returns and the standard deviation of those returns. And then below that graph, I also have the variance covariance matrix of all 5 of these stocks. So what the variance covariance matrix is a way of visualizing the variance or the covariance relationship between each of the 5 stocks with each other. So as you can see down the middle, highlighted in yellow, those are just the variances of the stocks themselves. So for Coca-Cola, you see that the 0.002147 matches up with the 0.00215 above. And then the covariance is you would go across the row and in the column that it is in to find the covariance between the two stocks. So you'd see for Coca-Cola and Microsoft, you see that it's 0.00863. That's the covariance relationship. And you see that it's also flipped across that line down the middle, and that they're just symmetrical. And what the covariance represents is the relationship of how the returns move up and down with each other. So if you have a positive covariance relationship, that means that the stock's returns tend to move in the same direction. And if you have a negative, that would mean that they move in the opposite direction. And the higher the number, or I guess the greater the absolute value of the number, the stronger that relationship is. So for NVIDIA and Salesforce CRM, you see it highlighted in green. That's the highest covariance relationship we found between our 5 stocks. And I think this would be due to just that they are in similar fields, both heavily in the AI cloud computing area. And so then a lot of the factors that are moving, causing returns, the market sentiment, they move in the same direction together. And then the lowest covariance is between NVIDIA and Coca-Cola, just because Coca-Cola being in the beverage industry and being such a mature company, and NVIDIA being in the high growth tech industry, the factors that are causing their stocks to move are just such different, so they have the lowest covariance. For part two, we were asked to find the optimal and minimal, the optimal risky portfolio of the 5 assets and the minimum variance portfolio of risky assets. So in order to do that, it's better to look over here at the spreadsheet. And when looking at the spreadsheet, so along the top here, these in blue are the weights of the stock. And you see that there's only 4, just because if you have 4, you can calculate the last one. So the weights of the stock are here in blue. And then below that is the covariance matrix from before. And then over here is the statistics of that portfolio based on the weights above. So if we put an even amount in all of them, 0.2 or 20%, the expected return would be 2.09%, and the variation in standard deviation here. And this Sharpe ratio is just a ratio of the the expected return of the portfolio minus the risk-free rate, which we calculated in part 1, and then all over the standard deviation. And it's just a ratio that tells you how much return you're getting per unit of risk, per 1 standard deviation unit of risk. And so in order to find the optimal portfolio of risky assets, we're trying to maximize this Sharpe ratio here. And to do that, we're going to use this solver function in Excel. So we would go into data and then solver. We're going to click on, for our objective, this is the cell that we're trying to maximize. So we want to change this to cell C14 to maximize. And then we want to have, by changing the variables in cells D3, E3, F3, and G3. And then you notice we can leave H3 out of there because, again, it can be calculated with just the 4 weights of 4 stocks. And then we're going to set the constraint variable as non-negative, and then we'll hit solve. And so then the solver will calculate the weights that maximize the Sharpe ratio here. And as you see up top, it came up with these weights in these stocks. And you'll see that down here. I summarize it a little bit cleaner. We get 19% in Coke, 35% in Microsoft, and 46% in NVIDIA. And this could just be due to the reason that you're not putting anything in Johnson & Johnson or Salesforce. It's just that Salesforce, like we've shown before, moves very similar, has a high covariance with NVIDIA. So if NVIDIA performs better and they're moving in the same direction, then there would be no benefit to investing in Salesforce over NVIDIA. And similarly with like Coke and Johnson & Johnson, since they have a high covariance that and Coke outperforms it, then it's better to just put it all in Coke. The expected return would be 3.4% and a standard deviation of 7.7%, giving you a maximum Sharpe ratio of 0.4205. And then to calculate the minimum variance portfolio, we're going to do a similar function here. We're going to go to this variance box. We're going to go back into the solver, and we're going to set our objective to this variance C12, and we're going to change this to the minimum. We want the lowest variance, and we're going to keep the cells the same. Now we're changing these weights in blue, and then we're going to hit solve. And we get these weights up here, and I've summarized them down here in the bottom. So we got 40% in Coke, 14.5% in Microsoft, 5.7% in Salesforce, 38.5% in Johnson & Johnson, and 1.3% in NVIDIA. This portfolio would earn expected return of 0.91% monthly and a standard deviation of 3.86% with a Sharpe ratio of 0.19. You see that the Sharpe ratio is much lower than the optimal portfolio, but you do have a much lower standard deviation.
Task 1, we were assigned to calculate the betas of the stocks that we analyzed from part 2. Beta is the measure of volatility compared to the market, and it tells investors how much risk they will be taking on if they invest in that certain stock. As you can see, we found that Coca-Cola had a beta of 0.52, Microsoft had a beta of 0.95, CRM had a beta of 1.25, Johnson & Johnson had a beta of about 0.54, and then NVIDIA had a beta of about 1.73. So as you can see, NVIDIA had the highest beta. This means that the stock will have the highest volatility, but when the market is performing, it will have the highest returns compared to the others. This could be due to the fact that NVIDIA is in the tech industry where markets have higher fluctuation compared to others. And then another reason is that NVIDIA is a growth potential stock. So investors are trading based on their growth potential, which can cause price swings and fluctuation when the expectations change in their world. And then Coca-Cola had the lowest beta, so it'll have the lowest volatility and somewhat moves with the market. This is because Coca-Cola is a mature company that has predictable revenue, and people will continue to buy soft drinks no matter how the economy is working, which means their price won't have many swings and doesn't fluctuate a whole lot. So in part 3, task 2, we were tasked with calculating the alpha of each of the stocks from before. Alpha is the measure of a stock's performance compared to the market after incorporating that stock's risk, which is their beta. This tells us whether a stock has underperformed or overperformed. So as you can see, we found that Coca-Cola had an alpha of about 0, which means it performed as we predicted. And then Microsoft had an alpha of 0.012, so it overperformed by 1.2%. CRM had an alpha of 0.0045, which means it overperformed by about 0.5%. And then Johnson & Johnson had an alpha of negative 0.0008, which means it underperformed by about 0.1%. And then NVIDIA had an alpha of 0.0398, which means it overperformed by about 4%. So as you can see, NVIDIA was the highest performer amongst these stocks, where Johnson & Johnson was the one that underperformed the most. So in part 3, task 3, we were told that we need to recommend one of the 5 stocks that we have analyzed throughout this project to a member of the investment team at the University of Iowa Foundation. After our analysis, we have come to the conclusion that NVIDIA is the best option for them to add to their portfolio. This is because, as we found in part 2, it offers the highest returns, and then in part 3, we saw that it overperformed the most compared to the other stocks. And the high beta that we found in part 3 can lead them to higher returns in a good market compared to the other stocks.